Just stop scrolling. If you are listening to this because you think I'm going to tell you to buy an index fund, open a Roth IRA, or follow the advice of a financial guru on social media, you can turn this off now. Seriously. Go save your time, because what I am about to tell you in the next 45 minutes is not in their brochures. It's not in their books, and it is definitely not something they teach in high school economics. We are taught that wealth is a ladder. We are told that if we work hard, save 10% of our paycheck, and invest in the S&P 500, we will eventually become rich. That is a lie. It's a comforting lie. It keeps the system running. It keeps you working. But it is not how the ultra-wealthy, the top 0.1%, actually operate. They are not playing the same game as you. They are not even on the same field. While you are trying to optimize your tax bracket, they have already exited the tax system entirely. While you are worried about inflation eroding your savings, they are using inflation to print money for free. Today, we are pulling back the curtain. I'm not talking about investing tips. I'm talking about the structural mechanics of the shadow economy. We are going to walk through the exact vehicles, the legal loopholes, and the psychological frameworks that the rich use to not just preserve wealth, but to exponentially grow it while everyone else is distracted by the stock market. This information is usually guarded by non-disclosure agreements, private family offices, and armies of lawyers. But today, I'm giving it to you, not to make you feel bad, but to show you the matrix. Warning, some of this will make you angry. Some of it might make you realize just how rigged the game truly is. But if you want to survive in the modern economy, you need to know how the other side plays. Let's go inside the mind of the 0.1%. Let's start with the biggest misconception of all. The average person believes that wealth comes from income. You work, you get paid, you save, you invest. It's linear, it's logical, and it is incredibly slow. The rich do not rely on income. In fact, for the ultra-wealthy, income is a liability. Why? Because in the United States and most developed nations, income is the most heavily taxed entity on the planet. If you earn a salary, the government takes its cut before you even see the money. Then you pay state taxes, local taxes, and Social Security. You are left with scraps. The wealthy do the opposite. They do not earn income. They generate wealth through appreciation and leverage. Here is the first secret: the rich never sell. If you own a business or stocks or real estate and those assets go up in value, you do not sell them. Selling triggers a capital gains event. That is a polite way of saying taxable income. If you bought a building for $1 million and it's now worth $10 million, selling it would cost you millions in taxes. The rich would rather die than sell. So how do they get money to live their lives? To buy the jet, the yacht, the mansion? They borrow. This is called the buy, borrow, die strategy. It is legal. It is standard practice for billionaires, and it is the ultimate loophole. Here is how it works. You take your $10 million in assets. You go to a private bank. You say, "I need cash for living expenses." The bank looks at your assets, sees they are solid, and says, "No problem." They give you a loan against your assets. Listen closely. Loans are not income. You do not pay taxes on loans. Zero, nada. While you are paying 30% or more in taxes on your paycheck, the rich are borrowing their lifestyle at interest rates that are often lower than the rate of inflation. In fact, in many cases, the bank pays them to take the money, or the interest is so low it's negligible compared to the growth of their assets. Let's do the math. If your assets grow at 8% a year and you can borrow against them at 3%, you are making 5% on money you didn't even earn. You are getting paid to exist. And when they die, the die part of the strategy, when a wealthy person dies, their assets are passed down to their heirs. Under current U.S. law, this is called a step-up in basis. The tax liability on the appreciation disappears. Poof, gone. The heirs inherit the assets at the current market value, with no capital gains tax owed. They can then sell a small portion to pay off the loan and still be richer than if they had worked a lifetime. This is why you see billionaires with billions in net worth paying zero in federal income tax. It's not a bug in the system. It's a feature designed for them. While you are trying to save every penny, they are using debt as a tool to extract unlimited tax-free liquidity. This is the first pillar of their wealth. Never sell. Always borrow. Now you might be asking, but what if the market crashes? What if the assets lose value? That's a valid fear, and that's why they don't put all their eggs in one basket, which leads us to the next secret. Where do they actually put their money when they aren't borrowing against it? Spoiler alert, it's not the S&P 500. If you walk into a party and ask a regular investor where they put their money, they'll say, I use Robinhood, or I have a 401k, or I buy ETFs. The rich laugh at this. To the ultra-wealthy, the public stock market is a casino for amateurs. It's transparent, it's regulated, and worst of all, it's crowded. When everyone can see the price, the opportunity is already gone. The real money, the life-changing, dynasty-building money, is made in the dark. The majority of wealth creation for the 0.1% happens in private equity and venture capital. These are funds that buy companies, take them private, strip them down, rebuild them, and sell them for billions. Or they invest in startups before they ever go public. Think about the biggest companies in the world. Before they were on the NASDAQ, they were private. The early investors, the people who got the inside track, made thousands of % returns. By the time the company IPOs and you can buy a share on your phone, the massive growth has already happened. The public market is where the insiders cash out and the retail investors are left holding the bag. How do they access these deals? You can't just call up a private equity firm and say, I want to invest. These funds are restricted to accredited investors and qualified purchasers. In the U.S., to be an accredited investor, you generally need a net worth of over $1 million excluding your home, or an annual income over $200,000. To access the really good stuff, the qualified purchaser status, you need $5 million in investable assets. This creates a two-tiered system. Tier 1 is the public market, where regulations protect you from losing everything, but also cap your potential gains. Tier 2 is the private market, where regulations are loose, risks are high, but the returns are unlimited. The rich operate in Tier 2. They invest in special purpose vehicles, SPVs. These are legal entities created for a single transaction. Maybe it's to buy a specific building or fund a specific tech startup or acquire a competitor. These SPVs are opaque. You won't see them on any public ledger. They are the shadow economy of finance. Why is this important for you to know? Because it explains why the wealth gap is widening. It's not because the rich are smarter. It's because they have access to asset classes that are legally forbidden to you and me. But wait, it gets deeper. Even within the private market, the super-rich don't just invest, they control. When a private equity firm buys a company, they don't just hope it goes up in value. They actively manipulate the outcome. They cut costs, they merge it with other companies to create monopolies, they load it with debt, just like they taught you to avoid, and they extract fees. Yes, you heard that right. They charge the company they bought massive management fees and transaction fees. So even if the company fails, the owners have already made millions in fees. It's a rigged game. Now, I'm not saying you should try to start a private equity firm tomorrow. That requires capital you likely don't have. But the lesson here is about access and structure. The rich understand that the rules of the game change depending on who you are. They spend their time building relationships and structures that grant them access to these private deals. They join private clubs, they attend exclusive conferences, they network in circles where these deals are discussed over cigars and whiskey. If you want to emulate this, you have to change your mindset. Stop looking for the next hot stock on Reddit. Start learning about how businesses are bought and sold. Start networking with people who own businesses, not just people who work for them. But even private equity has risks. What if the economy crashes? What if the market goes to zero? The rich have a solution for that too, and it involves something you've probably heard of but don't understand. Gold, no, Bitcoin, maybe, but not primarily. They use something much more powerful. They use the ultimate safe haven. Let's talk about art. You might think buying a painting for $100 million is insane. You might think it's vanity. And sure, for some, it is. But for the sophisticated investor, high-end art, antiquities, and collectibles serve a very specific, very lucrative purpose. They are uncorrelated, unregulated, and invisible. When the stock market crashes or when inflation hits, traditional assets lose value. But a Picasso, a rare Stradivarius violin, a vintage Ferrari, these things do not correlate with the S&P 500. Their value is based on scarcity and the desire of other wealthy people. And there will always be wealthy people. But the real trick isn't the appreciation, it's the financing. Just like with stocks, the rich can borrow against their art collections. But here's the kicker. Art loans are often non-recourse. This means if the value of the art drops, the bank can take the art, but they cannot come after your other assets. It's a one-way bet. Furthermore, art can be moved. It can be stored in freeports. Freeports are secure storage facilities located in international zones, often near airports. They are legally considered in transit. This means no taxes, no customs duties, and no questions asked. You can buy a painting in New York, ship it to a freeport in Geneva, and sell it to someone in Asia. The painting never technically enters any country. No sales tax, no VAT, no capital gains tax. The ownership just changes hands in a ledger inside the freeport. This is how billions of dollars move around the world every year, completely invisible to regulators and tax authorities. It's not just art. It's rare wine, classic cars, rare stamps, and even digital assets. Now I know what you're thinking. I can't afford a Picasso. And you're right, most of us can't. But the principle is what matters. The rich diversify into assets that cannot be seized, frozen, or easily tracked. They invest in things that have intrinsic value but no paper trail. This brings us to a controversial topic, a topic that the mainstream media will tell you is a scam or a fad. But the institutions are already there. Bitcoin and cryptocurrency. Love it or hate it, the narrative that crypto is for criminals is a smokescreen. Yes, criminals use it. But so do the world's largest hedge funds, family offices, and increasingly, sovereign nations. Why? Because it is the only asset in the world that cannot be confiscated if you hold your own keys. The rich are paranoid. They worry about seizure, about capital controls, about being locked out of the system. Crypto offers an exit hatch. While the average person is told to keep their money in a bank, which can be frozen, or buy government bonds, which can be inflated away, the smart money is allocating a small percentage, 1% to 5%, to asymmetric bets like Bitcoin. Not to get rich quick, but to ensure they can never be made poor by the state. This is about sovereignty. The rich invest in their own sovereignty. They want control over their destiny. But let's step back from the financial instruments. Because the biggest advantage the rich have isn't a specific asset. It's a structural advantage that you can replicate to a certain extent. It's the art of the family office. If you have $100 million, you don't go to Morgan Stanley. You don't go to Fidelity. You build your own bank. It's called a family office. A family office is a private company that manages the financial and legal affairs of a single family. It employs lawyers, tax experts, investment managers, and security personnel. Their only job is to protect and grow that one family's wealth. Think about the conflict of interest in the traditional model. When you go to a big bank, their advisors are often incentivized to sell you products that benefit the bank, not you. They push mutual funds with high fees. They push insurance products you don't need. In a family office, the fiduciary duty is 100% to the family. There is no conflict. But the real power of the family office is the aggregation of resources. Instead of paying for legal advice hourly, they have a lawyer on salary. Instead of paying for investment research, they have their own analysts. This allows them to do things you can't. They can invest in litigation finance, suing companies for a cut of the settlement. They can buy distressed debt and foreclose on properties legally. They can structure complex tax arbitrage schemes that require a team of experts to execute. Now you might say, I don't have $100 million. This doesn't apply to me. Wait. The concept of the family office is scalable. You don't need millions to start thinking like a family office. You need the structure. You can create a micro-family office. Start by separating your personal finances from your investment entity. Create an LLC. Treat your finances like a business. Hire a CPA who specializes in aggressive but legal tax strategies, not just tax preparation. Pay for high-quality legal advice before you make big moves. The rich understand that wealth preservation is a full-time job. They don't trust anyone else with the keys. They educate themselves relentlessly. If you are relying on a financial advisor who charges 1% of your assets under management, you are being ripped off. That 1% compounds over time to steal a massive chunk of your wealth. The rich would rather pay for hourly advice and keep control. Take control. Learn the laws. Understand the tax code. The tax code is not a set of rules to be obeyed. It is a set of incentives to be exploited. The government wants you to do certain things, like build housing or produce energy or create jobs. They offer massive tax breaks for that. The rich align their investments with these incentives to get rich and pay zero tax. This is the difference between the employee mindset and the owner mindset. The employee tries to avoid taxes by hiding income, which is illegal. The owner tries to minimize taxes by changing the nature of their income, which is legal. But there is a darker side to this, a side where the pursuit of wealth crosses ethical lines. We've talked about the legal strategies. Now let's talk about the moral ones. There is a saying in the financial world, the best time to buy is when there is blood in the streets. The rich do not panic during a crisis. They prepare for it. In fact, many wealthy individuals and funds actively position themselves to profit from disasters. When the economy crashes, assets are sold at pennies on the dollar. Desperate people need cash. They sell their homes, their businesses, their life savings for whatever they can get. Who buys them? The rich. This is called distressed asset investing. It's not glamorous. It involves buying foreclosed homes and evicting families. It involves buying struggling companies and firing thousands of workers to make the balance sheet look better before selling it. Is it cruel? Absolutely. But it's how empires are built. The rich have the liquidity to act when everyone else is paralyzed. They have the cash reserves to wait out the storm. And when the storm passes, they own everything. This is why inequality grows during recessions. The poor lose everything. The rich buy it. You might feel angry about this. Good. That anger should fuel you to build your own liquidity. Because if you are living paycheck to paycheck, you are the prey. If you have cash and assets, you are the predator. There is no moral judgment here. This is just how the system works. The rich understand that morality is a luxury they can't afford when it comes to business. They also understand the power of information asymmetry. Before a new highway is built, before a new airport is approved, before a zoning law changes, someone knows. And that someone buys the land. This isn't always illegal insider trading in the corporate sense. It's often just Network intelligence. They know the right people. They hear things at the golf club, at the charity gala, at the private dinner. They invest based on future reality, not current data. If you want to play this game, you need to change where you get your information. Stop watching the news. The news is for the masses. It tells you what already happened. Start listening to local planning committees. Start reading zoning laws. Start talking to developers. The money is made in the gap between what the public knows and what the future holds. This is the edge. The rich are always ahead of the curve because they are the ones drawing the curve. But let's get back to something more tangible, something you can actually touch. Because while digital assets and private equity are great, the rich have a very old-school obsession. Land. They aren't making any more of it. The ultra-wealthy are the largest landowners on the planet. Bill Gates is the largest private owner of farmland in the U.S. Other billionaires own massive chunks of timberland, water rights, and mineral rights. Why? Because land is the ultimate hedge against inflation. When the dollar collapses, land remains. When the world goes to hell, the person with the food and the water is the king. But it's not just about holding it. It's about what you can do with it. Through conservation easements, the rich can get paid not to develop their land. The government pays them to keep it as a forest or a farm. They get a massive tax deduction for the lost value of not building on it, while still owning the land, still enjoying the tax breaks, and often still harvesting timber or farming under strict guidelines. It's a double win. They get paid to do nothing and they get a tax break for it. Furthermore, land can be used for carbon credits. In the future, owning trees will be like owning oil. The rich are positioning themselves to sell carbon offsets to corporations. They are monetizing the air and the soil. This is the level of thinking you need. Don't just think about buying a house to live in. Think about buying land to control resources. Even if you can only afford a small plot, the principle stands. Ownership of productive land is the foundation of true wealth. Everything else is just paper. But what about the future? What about AI, robotics, and the changing world? The rich are already there too. The rich are not afraid of technology, they fund it. While the average person worries about AI taking their job, the rich are investing in the AI companies that will replace the workers. They are investing in biotech firms that are trying to cure death. Yes, longevity research is a massive area of investment for the ultra-wealthy. They are pouring billions into trying to extend their own lives, and if they succeed, they will own the technology. This is the ultimate selfishness, but it's also the ultimate investment. If you can extend human life by even a few years, the value of that technology is infinite. They are also investing in private prisons, private security, and private military contractors. As the world becomes more unstable, the demand for security will skyrocket. The rich are preparing for a world where the state cannot protect them, so they build their own protection rackets. This might sound dystopian. It is, but it's the reality they are building. They are betting on a future where the gap between the rich and the poor is not just about money, but about life expectancy, security, and freedom. So there it is, the unfiltered truth. The rich don't work for money. They don't pay taxes. They don't invest in the public market. They use debt to buy assets, they hide in private markets, they exploit legal loopholes, and they invest in the very fabric of reality, land, data, and life itself. Is it fair? No. Is it legal? Yes. Can you do it? Not exactly as they do. You don't have the capital yet. But you can start thinking like them. Stop trying to save your way to wealth. It's impossible. Start looking for leverage. Start learning the tax code. Start building assets that cannot be seized. Stop trusting the system to save you. It won't. The game is rigged, but knowing the rules allows you to play it better. Or, at least, it allows you to see the trap before you step in it. The choice is yours. You can continue to play the victim, complaining about how unfair it is. Or you can wake up, learn the game, and start building your own empire, however small. If you found this valuable, do me a favor. Don't just like it, share it. Because the more people who know the truth, the harder it is for the system to keep lying to us. Stay sharp, stay skeptical, and never stop learning.